Almost every contrarian indicator possible flashed the buy signal last week, including famous folks piling on at the exact wrong moment. So is what's happening right now just what you would call a run-of-the-mill bear market bounce or something more substantial? Paul Schatz is with me, along with Gina Bolvin. And Paul, you know, I read where you sold some of your European positions, emerging markets. You closed out some hedges. So does this mean that you see this sustained rally from here?
Hey, Charles, good to be with you. I definitely don't see a sustained rally from here. Last time I was on, I talked about what I thought would be a single-digit decline in the first quarter. It's been certainly compressed, magnitude a little higher than I thought. Last Monday, we saw a nice momentum internal low, but I think similar to January of 18, we're going to thrash around for a little bit. I did buy some super beaten down stuff. What I sold, I ended up putting in the S&P 500, but I bought some junky stuff too. I bought ARK, and I bought some stocks, and I bought some biotech because I thought they would bounce. But there's stuff I want to rent. I don't want to own it yet. I think that time will come later in the year. I think you need to be nimble and eventually rotate into quality and defensive stuff until proven otherwise this year.
All right, that's what Jay Powell said. You got to be nimble and humble. Gina, what do you think? Did we hit a near-term bottom or no?
Hi, Charles. Great to see you again. It's important for investors to remember that bottoming is a process. And last week, investor sentiment reached all-time lows since 2013. Now think about that. Investors were more negative on the market last week than they were at the beginning of a global pandemic. So is that warranted? We don't think so, probably not. And we see that negative sentiment as a bullish sign.
You know, I'm concerned with how much retail investors are not only buying puts, they're buying puts with less than a week to expiration, Gina. You know, listen, they're not going far out of the money per se. Obviously, though, this is excessive to hedge. I mean, is there some other hedging approach that maybe they want to take where the hedge itself doesn't become the risk?
Well, the put to call ratio is about as negative as it gets, and I would never try to guess the direction of the market in a day, a week, a month, and never mind trying to do it during times of extreme volatility. So we see this put to call ratio as another contrarian bullish sign.
Paul, you mentioned you know, things like the stocks, ARK Fund. I don't know. I wouldn't put those two together, right? I mean, and we're talking about semiconductors, everything in the future, everything we do. This conversation couldn't happen without semiconductors. So, I mean, are there certain names? Because I also saw a whole bunch of big time upgrades on some of these beaten down names. Can you distinguish between, let's say, really ultra risk, non-profitable tech against something like an AMD that might just be oversold?
Well, you mentioned AMD. We bought AMD and we bought Tesla, and I imagine we'll hold that for a longer period of time. But I would also, again, you know, the ARK stuff is not what I would consider quality, but it was so beaten down and so washed out. I bought some at higher levels. Gino's talking about sentiment, you know, between the put calls and the spike in new lows and the American Association of Individual Investors and the DSI. I mean, again, bottoms are not points in time. They're like mattresses you kind of fall into and you come out of. It's a bottoming process. I think if you're a nimble investor and you can trade these names, then the semis you like the semis. I like them long term. I'm not going to load up on semis this year. I think it's a year for patience and quality. And I don't really put a lot of the semis in that basket just yet. The quality I would call would be like Kellogg's and some of the staple names, boring, not sexy, but they're going to allow you to harvest those acorns in what could be an up and down year on balance, like we've seen in other years where the Fed has been less than accommodative.
Gina, what do you like here? What sectors or stocks or do you like more so than others?
Well, we do like cyclical value stocks, and a year ago I came on and we talked about financials, and they've had a good run, but we still like them as rates rise. We like industrials. We also like the real estate sector. 40% of the real estate sector is tied to technology trends like wireless infrastructure, cloud computing, and e-commerce. So that's why we like real estate. And yeah, we do like quality technology, but we do not like defensive names like healthcare and like consumer staples. This year might be volatile, but we're bullish on stocks for the year.
All right. Gina, Paul, thank you both.